Investopedia, the 86% failure, and why the banks stayed quiet. Did Investopedia just prove something that I've suspected for a long time? Why banks stayed quiet about retirement cash. On February the 5th, 2026, Investopedia published a headline that should have caught the attention of every retiree in America. It warned that 86% of high-risk retirees are failing a crucial diversification test. Now hang in there with me. Here's the part that matters. That headline wasn't based on a brand new piece of information. The underlying data came from a study released in August of 2026, roughly 6 months earlier. The study surveyed more than 1,000 investors. Of that group, 22% were classified as high risk, 57% as medium risk, and 21% as low risk. Now, we need to talk about who's actually running the radar in this study. This 86% failure rate comes from research sponsored by Jackson National, a major annuity provider. That doesn't mean the data is wrong, but it does mean the flight path they've suggested is quite intentional. My goal isn't to tell you those tools are good or bad. I just want you to realize that when a company sells a parachute and the engine is vibrating, well, the warning might be real, but the solution they're nudging you towards isn't neutral. They're pointing you towards their own runway. So the question today isn't whether the data is real or not. It is. The question is this: why did it take some 6 months for this warning to reach everyday retirees? Because once you understand that delay, you start to understand something much bigger than cash. You start to understand latent incentives. And once you understand incentives, a lot of quiet behavior, well, it suddenly makes sense. Today we're going to talk about why banks stayed quiet. Not because of bad intent, but because the system does not reward them for being loud. Let's slow this down a bit and get very precise about what that 86% actually means. It was not that retirees were gambling. It was not that they were chasing speculation. It was not reckless behavior. The nuance, it's this: they failed to meet a basic asset diversification benchmark. Under stress conditions, their portfolios did not meet the diversification standard being measured. And the trap, well, it was not greed, the trap was comfort. A large share of these high-risk retirees were over-concentrated in cash. The study found that roughly 49% of these retirees in that high-risk category held nearly half their assets in cash-like instruments. That's well above the commonly cited guideline of around 20%. So, when you hear the word failed, hear this: they failed because they were hiding in cash, not because they were gambling in cash. That line matters because it bridges directly into the biggest misunderstanding in retirement. Cash feels safe. But cash can become a trap if it's not assigned a job. Now, let me add something from my worldview, where I was a military pilot for 12 years and a commercial airline pilot for 35 years. In aviation, a pilot's certificate, it's absolute. The standards are clear, the systems are binary. It's a yes or a no, a black or a white. And your life depends on them. But in this industry, the definition of a financial planner is sometimes about as clear as mud. Unlike a pilot, almost anyone can claim to be an expert while leading you straight into a cash trap. By the way, I'm not an expert, I'm not a CFP, I'm not an accountant, but what I do is spend a lot of my time researching financial matters, particularly in the category of baby boomers. Now, this recent study provided that 86% of retirees are failing a substantial benchmark, and most of them are failing it because they were hiding in cash. Yet no one rang the alarm bell. And why is that? If I may draw upon my world, I didn't need to know how to build a Boeing 747 to fly that beautiful beast over the skies, but I did need to know how to master its systems. What I'm pretty sure makes me different than many on YouTube is that I'm not here to sell you products, get you on an email list, or sell you some kind of a service. I do hope to share retirement strategies that have worked for me. My goal is to approach retirement and finance with the same systems level seriousness I applied to flying a C-130 or a Boeing 747 or even an Airbus. This is the framework that has worked for me over the decades. My hope is that my research provides clarity for your own planning, clearing up the muddy parts of an industry that rarely provides a flight manual. And by the way, if you want the full operating system I use, not just a warning, I already built into a separate episode. It's called the 5-Bucket Firewall. Today is the why. That episode is the how. Now let's make it concrete. Imagine a retiree with $500,000 portfolio. $250,000 of that 500 is sitting in CDs and money markets. Comment at the end if this sounds like your situation, by the way. It earns 4% a year, and that sounds fine. But after inflation and taxes, real returns can be 0%. Now, that $250,000 loss represents $7,500 in purchasing power lost each and every year. Over 5 years, that's nearly $40,000. Over 10 years, that's roughly $80,000. No crash, no panic, no headlines, just straight up erosion. And that erosion increases the risk of outliving your savings. Over allocation in cash and bonds does not eliminate risk. It shifts the risk to inflation and longevity. Experts identify one of the most common retirement mistakes as equating safety with cash. But it doesn't stop there. That'd be too easy, wouldn't it? Some investors seeking safety also overconcentrate in dividend stocks and bonds, focusing heavily on current income while underweighting long-term growth. The intention is safety. The results can be stagnation. That stagnation is drag on your portfolio. And that drag is what we called parasitic drag in my world, flying jets around the world. And you know you're suffering parasitic drag when it degrades the performance of either your jet or your portfolio. Safety without growth can quietly become failure. Now, we arrive at the incentive question. Banks are required to disclose interest rates. They must disclose terms. They must disclose fees and FDIC limits. They are not required to disclose inflation-adjusted outcomes. They are not required to model whether your retirement plan survives a bad first decade. There is very little institutional incentive to proactively warn retirees about the long-term damage of excess cash. Cash is stable funding. Stable funding is valuable. Encouraging money to leave the balance sheet reduces that stability. That does not require bad intent, it requires math. Industry research moves through professional channels first. Consumer media arrives later. That lag is not a conspiracy. It is inertia. Now, what do experts recommend? They recommend a balanced approach. Diversify across asset classes rather than leaning too heavily on stocks or relying solely on cash and bonds. A common recommendation is to hold 3 to 5 years of cash as money markets or individual bonds or short-term bonds. That recommendation is not unreasonable, but arguably unobtainable by a lot of people. The point is that cash has a role, but most retirees do not stop at 3 to 5 years. They drift into cash because it feels good, not because it's engineered. In my framework, the 5-bucket firewall, I typically structure bucket 1 as 12 to 14 months of expenses. Why smaller? Well, because cash, in my mind, is insurance. And insurance should be sized intentionally. Cash is not the enemy, unassigned cash is. Let's simplify the system. Bucket 1 buys time and is what I call the insurance bucket. Bucket 2 is the staging area. Bucket 3 absorbs volatility. Bucket 4 is the engine that fights inflation. Bucket 5 is the fortress for later decisions such as Roth positioning. When this system is in place, markets become something you can manage, not something you fear. Failure is rarely emotional, but it is almost always mechanical. Cash without assignment, growth without insulation, Withdrawals without flexibility. One of the key strategies experts recommend is dynamic withdrawals. Spend less in down years, spend more in strong markets. Adjust allocations when conditions change. Do not blindly follow a mixed percentage every year. Retirement is not static. Markets are not static. Your strategy cannot be static. You must know how long cash is expected to last, and you must know what refills it and when. You must know which assets are protected from early withdrawals. You must know how spending adjusts after bad markets. Responsibilities shift at retirement. No institution is required to model this for you. Now, here's the simple market test. If markets drop 25% tomorrow and stay down for 2 years, which account pays your bills? If the answer is, I would sell something or wait and see, you don't have a system, but you do have hope. And hope is not a retirement plan. What we covered today explains why excess cash builds up and why no one rushes to warn you about it. It does not show you what that does to your time, your taxes, or your ability to survive a bad market early on in retirement. These are separate problems. Check out my channel for deeper dives into understanding the personal costs of sitting on cash. Start with cash rich, time poor. If you want to see how timing risks collide with withdrawals, watch Vanguard Crack the Door Open, the real sequence of return risk problems. And if you're concerned about Medicare and tax consequences when repositioning assets, the Irma Ambush episode matters before you touch anything. Those are already on my channel.